Want to beat down today's higher mortgage rates? You might want to consider a temporary rate buy down where your mortgage rate starts 3% below the market rate. And believe it or not, it's a fixed rate loan.
Wait, what?
Yeah, it's not like an adjustable rate where you don't really know what's going to happen with rates. This one, I can tell you at the point of application what the rate will be each year. Let's talk temporary rate buy downs. I'm Peter Lindquist. We're going to talk about this great strategy for buying a home in today's market called temporary interest rate buydowns. We're going to talk about all the buydown options, how do they work, who are they for, and how to negotiate them. I'll be your guide today as we talk about all things temporary rate buydown. If you like this video, be sure to click the little thumbs up that says you like it and click the subscribe button, and don't forget to click that little bell. And hey, do you know anyone who has used it? Please share in the comments below so that others can benefit from your experience. And if you've got any questions, leave them there as well. Now let's talk about temporary interest rate buydown options. So the most common that you might have heard of is called a 2-1 buydown. So when we talk about temporary rate buydowns, the numbers refer to the percentage off of the long-term rate in which the years represent. So a 2-1 temporary buydown means that in the first year, your mortgage rate is 2% below the long-term rate. Then the second year is 1% below the long-term interest rate. And then years 3 through 30 will be the regular rate. So 2-1 temporary buydowns, very common. But another one that has become increasingly common is called the 3-2-1 buydown regular rate. That gives you 3 years with reduced interest rates to get accustomed to your mortgage payment for your home. But since we all have different needs, there's different kinds of buydowns as well. There's a 1-1-1 buydown that should be used more commonly. That one, the interest rate is 1% off for 3 full years and then becomes a long-term rate. Then there's a 1-0 buydown. That one is pretty easy to access for anybody, and that's where the interest rate is 1% below for the first year. And then there's one that's called 1.5, 0.50. So that's 1.5% off of the first year, 0.5% off the second year. Buydowns can be used for conventional financing, FHA, VA loans, and jumbo loans are even available on a limited basis depending on the investor. The only real programs I can think of right now where it's not used is USDA loans or what we call bond loans. For example, through MHFA, the Minnesota Housing Finance Agency, for your state bond loans, those are not available. Okay, let's talk about how temporary rate buydowns work. The basic premise of this is, well, maybe the easiest way to think of it is the seller puts money into an account that is your money, and from that account, the loan servicer, the people you're making payments to, is going to draw from that to reduce your monthly payment over a period of time, over the first 1 to 3 years. So it's sort of like a savings account. It's not earning any interest, but it's an account that the loan servicer holds to reduce your monthly payments. Let's take a look at an example of a 2-1 buydown. These numbers are not exact, but it gives you the idea. So let's say that your temporary rate buydown required the seller to pay $7,600 into the subsidy. And let's assume that your mortgage payment was $2,500 a month. And if you felt uncomfortable with that, temporary rate buydown could end up solving this. So the way this works is that in year one, the loan servicer who's got this $7,600 is going to take $425 each month to reduce your monthly payment so that your monthly payment is only $2,075 a month. And that's the way it works for the first full year. Now, naturally, at the end of the year, they've drawn down the subsidy account, so you have about $2,500 left. So now in year two, they're going to draw, let's say, $208 a month towards your monthly payment. So your payment goes up from $2,075 to $2,292, which is still better than that $2,500 figure. Then years 3 through 30, the subsidy account is gone, and now you're back to the first full year of the payment. So one thing buyers worry about is, well, what happens if interest rates drop, which we all hope that they do, and they drop during the subsidy period? What happens to the money that is set inside that subsidy account? So would you refinance that loan? Let's say that you're refinancing this loan inside of 1 year after you have taken it, and now you've got this money in a subsidy account. The remainder that's left in the subsidy account is your money. So you're not losing anything. The money that is in the subsidy account will be applied towards your principal balance. So there's really no loss with this program. So who is the program for? It's ideal for borrowers who are confident that their incomes are going to increase over a period of time. That increase from year one to year two is about 10%. So, how much of that 10% is going to be made up from your annual raise at your employer? And also, it gives you a chance to acclimate to that mortgage payment over a period of time without jumping right into the higher mortgage payment. I like to think of this as a short term solution towards a long term goal. You know, the buyers in today's market are taking advantage of lower prices. A year ago, home prices were skyrocketing. People were paying well over what the list price was. But in today's environment, buyers are able to oftentimes negotiate either a better price or they're able to negotiate concessions. Concessions are what the seller pays towards your benefit, and part of that can be used for temporary rate buy down. So it's important to understand that you have to negotiate the temporary rate buy down at the point that you are making the offer on a home. A home buyer that is interested in this program is contacting me before they make the offer so I can tell them exactly what they need to do in the purchase agreement to ensure that they have enough money coming from the seller to go into that subsidy account to make the program work. The home buyer themselves can't put the money into the subsidy account. It has to come from the seller. Now, conceivably, it can come from the lender, but that kind of benefit has gotten very difficult in today's world because you have to take a even higher interest rate for the lender to make more money on the loan to put into that subsidy account. Not a good idea. It's really for the seller to pay money into that escrow account. If you're interested in this program, you also need to be thinking of the right kind of property. This is not an ideal program for a property that just came on the market this morning. This is really designed for a property that has been on the market for some time. It might be a couple of weeks, it might be a couple of months, but you want to have a property where the seller is realizing that it may take some time to get their home sold, and now they are willing to negotiate with a home buyer who is asking for what we call seller paid closing costs that is used for this temporary rate buy down. Let's look at an example. Let's say that you found this $400,000 home, you're making a $400,000 offer. Now, I'm telling you that in this example, that you need $12,000 in seller paid closing costs in order to fund this temporary buy down subsidy account. Well, when you make that $400,000 offer and the seller pays $12,000, the seller is netting $388,000 because you're giving them 400, but you're asking for 12,000 back. Okay, so on the day of closing, they're getting 388,000. Now it's important for you to understand you're paying 400,000. You're not paying 388. You're paying 400,000. So the house has to appraise out to 400,000. Now, just a brief mention as to why sellers sometimes are not willing to take an offer with seller paid closing costs. If your net offer is 388,000 and they've got a competing offer for 388,000 that has no seller paid closing costs, the seller is likely going to take that other one because they're worried about the appraised value. In your case, the house has to appraise out to at least 400,000, where in the competition's case, it only has to appraise out to 388,000. Since the appraisal can take a week or two, the seller doesn't want to take their house off the market and then have the house appraised low. And now, as a buyer, you're free and clear of the purchase agreement, and they've got to go back out and market the home again. If they don't have other offers on the home, they are more likely to be willing to accept this offer. And I'm telling you, we're seeing these accepted every day in our market. Temporary rate buydowns are a great way to combat today's higher interest rates. They give you a lower monthly payment to begin with, and they contain very little risk. And you even get your money back if you refinance during the subsidy period. I'm with the Lindquist team. If you've got questions on temporary rate buydowns or anything else related to mortgages, feel free to put it in the comments below or shoot me a text. My contact information is all in the description below. Thanks for listening.